I am the Chief Investment Officer of Solaris Investment Management, and I wanted to have a chat today a little bit more locally about the Australian equity market and where we see things currently. Where are we in the equity cycle? I'll talk about three things today, some traps we see out there at the moment, some opportunities, and we do see some opportunities. But let's have a look first at the current state of play of the market. So if we look at the market, there is no news here that is surprising to anyone, I wouldn't have thought. It's been a pretty strong run. And while it felt like Armageddon at the time, the GFC, while not quite a blip yet, really isn't that dramatic on the chart. So it's been a long time between drinks. We haven't had a major correction for a little while, and we've had some pretty strong performances in the equity market. So we think it's modestly overvalued, the Australian equity market, and there's two pockets of the market, the China-facing consumer stocks in the growth space and the tech stocks in the small cap space that we think are particularly expensive. And for both of those, we've reduced our positions and in the long short fund taking some short positions for those pockets. So the big question is, how does one attack let's say the later stages of a bull market? There's a really good quote there from Peter Lynch, who wrote that fantastic Wall Street classic, One Up on Wall Street. I'll just read it to you. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than there has been lost in the corrections themselves. The lesson being that it's very dangerous to take a whole negative approach, throw all the rules out the window just because you're at a different stage of the cycle. The fundamental approach to pick good companies with reasonable outlooks, strong balance sheets and sensible valuations that will always endure in any market. So we still find a few of those. They're getting more scarce, to be fair, but we still find a few of those in the current market. So let's have a look at one of the traps. It's been talked about a little bit, but the question is, what is defensive, or more particularly, what is an effective defensive investment in such a market? And for us, it's a real trap for investors to just blindly skew portfolios towards so-called defensive investments, and particularly if yield is the only attraction of that investment. The case study I'll use, everyone else has slipped the boot into Telstra, so I thought I'd do the same. Telstra, no surprise here. It's been a pretty poor year. That's the last 12 months, Telstra versus the market in blue, Telstra in red. And you might say, well, that's just 1 year. I got compensated by a 5% fully franked yield. What's the problem? Well, the problem is, it isn't just 1 year. Telstra was listed in 1998 when sold by the federal government, and it's been pretty much a similar story for its entire listed life. They've been plagued by many, many earnings issues over that period. Now, the next chart is a pretty dramatic comparison, but it shows why growth is important, even in the defensive analysis. And one must consider growth, or at least the sustainability of yield, when one looks at an effective defensive investment. So let's compare, it's not very flattering, Telstra versus CSL. They were both, interestingly, sold by the federal government within a year and a half of each other in the mid to late 90s. CSL has gone up more than 200-fold over that period, unbelievably. And you were offered a very low yield at the start of less than 1%. You never would have bought it for a yield. If you were smart enough to hold CSL that whole period, you'd now be getting more than 100% yield every year. Telstra, on the other hand, has found a way, despite its secure defensive status, to lose more than 40% of its value over that period, and you are now getting a 3% yield. So growth matters, and growth is important. And despite the chart, unfortunately, we see Telstra's competitive headwinds as strong as ever. Vodafone and the Singtel-led Optus refuse to go home. Good money after bad, year after year after year. The NBN provides another level of ambiguity in the competitive landscape, and now TPG have thrown $2 billion into the mix for their mobile expansion. So we have been zero weight or short Telstra for many years, and we won't be changing soon. So what do we like? Well, it's not positive, but we think there's lots of shorting opportunities. And that's logical. As the market increases in value, you see more overvalued situations that you can take advantage of in a long-short fund by shorting those opportunities. I'll just step back a little and tell you how we approach the shorting universe at Solaris. Our philosophy is to divide the shorting universe into three distinct buckets, as you can see on the pie chart on the screen: outright shorts, funding shorts, and pairs trading. Now, each of these have different idiosyncrasies, different approaches, and we think in doing this, we diversify the alpha streams we can get from shorting, but significantly B, we can reduce the risk that comes with shorting. And shorting isn't necessarily effective if you just approach it as the inverse of going long. If we put all of our shorting eggs into the outright short bucket, the traditional shorting approach, we would, in my mind, come into short squeeze territory, crowded shorts, a much higher risk shorting environment. So we do see opportunities in the outright shorts. They're the traditional shorts, and we have quite a few of them on at the moment, and they're increasing in their number, particularly in those two pockets of the market that I mentioned that are quite expensive, the tech stocks, the China-facing consumer stocks. But augmenting the risk here in shorting can be done using the other two strategies. So I was going to talk about funding shorts first. I will come to the pairs trading. But on the funding short side, you still get the same downside protection here. You just do it with a little bit less risk. And funding shorts have been like the quiet achiever of our long-short portfolio. They aren't quite as glamorous as chasing a train wreck, a Slater and Gordon, the next disaster, but they are highly effective, if not glamorous. And the goal, the hurdle for success for the funding short is much lower than the outright short. All we're chasing here is an ability to underperform the conviction longs into which the short capital in a 130-30 fund gets deposited. And so a funding short might even go up in value. You'd prefer it not to, but it could, as long as it underperforms the conviction longs. And in our space, I've talked about Telstra, I will talk about AMP, Ramsay Health Care, GPT, Amcor on the board, which we no longer think the multiple matches the earnings outlook. All of these are really large, liquid, mid to large cap stocks that don't have funding issues, short squeezed, availability of borrow, all those issues that people associate with shorting, they're not a feature here. So boring is beautiful. We find the funding shorts a very underrated part of the short universe. I'll just walk through Fletcher Building as a case study here. And I wanted to talk about Fletcher Building because it's a bit of a life cycle of a short. We've actually closed the short now. But Fletcher Building was a New Zealand company, building materials company that chose to go west. Good rule of thumb, when New Zealand companies go west, Queensland, from my neck of the woods, companies go south, Australian companies go north, short, short, short. Fantastic opportunities. And usually that's because the competitive advantage in the new market doesn't match that of their home market. So there's real logic to this. And indeed, Fletcher Building, after multiple downgrades in their ill-advised expansion into the Australian building materials market, dropped 30 to 40%. But shorts have a price, like longs, and they have a life cycle. You close them out when they reach their target price. And indeed, Fletcher Building got to a point that we thought was quite attractive. And one of the big negative parts of our thesis was the stretched balance sheet. And they finally admitted the ills of their expansion west, put the white flag up, raised equity in a deeply discounted rights issue that was pretty attractive. So we closed the short. As time would show, it would have been smarter to actually go long at that point, but we weren't that smart. We just closed the short. But that was 30-40% gain, and we didn't expect to have anywhere near that success. So the funding shorts can creep up on you, and they've been a big part of the long-short fund success in the last 12 to 18 months. So what, if anything, do we like? We do still find some things to like. So I'll play a bit of a who am I game. Sing out if you know the answer, feel free. I actually did it with the team back in Brisbane and no one got the answer, so I think the clues are a bit hard, but feel free to sing out. A few sang out in Brisbane. I was born in 1996 in a listed market sense. I have EPS growth, CAGR of 13.5%, so for the numerically minded amongst us, over that period since 96, that's an 18-fold increase in earnings. So 13.5% may not seem that exciting, but if you can do it every year for that period, it's very powerful. I spread my business roughly a third across the US, Australia and the rest of the world. I, against all popular perception, have less volatility than the rest of the market. I am categorised in a perception sense of being very highly volatile in my earnings streams, which is completely incorrect. I have very low volatility, even lower than the major banks at the moment. It's not CSL, but you're the first person to answer, sir, so that's an excellent effort. So, it's 13 times PE. It's actually 13 and a half because it's rallied a bit since I lodged the slide pack. It is Australia's biggest fund manager with 500 billion of funds under management. Someone said platinum yesterday. I think that's a bit flattering to platinum, even though they've done extremely well. I am Australia's only listed investment bank. I am, of course, the Millionaire's Factory at Macquarie, the silver donut, the greatest logo in Australia. And Macquarie is, in stark contrast to some of those shorts, it has an earnings history and an earnings outlook that doesn't match its PE the other way. And the reason is that people still, despite that 13.5% EPS CAGR over 20 plus years, people still see it akin to the JP Morgans, the Goldman Sachs and the volatility of the global investment banks. And it's just not how they have delivered their earnings over time. In fact, more than 75% of the earnings come from annuity streams. They're the world's biggest airline leaser, weird niches like that, a Sander purchase, largest fund manager in the country. And it's only 25% of the business that has that higher risk aspect. However, the downside of the Macquarie position, which we've held for many years and we still have a high conviction on, despite the increase has largely been EPS driven, not re-rating. If the market were to have a major correction, Macquarie would have a headwind. And so how do we mitigate this risk? And this is where the pairs trading comes into play. You're trying to get two stocks, one overvalued, one undervalued, in the same industry with homogenous features. And obviously you go long the one that's undervalued, short the one that is overvalued, and hopefully mitigate or even eliminate that common risk. And in this case, it's financial market risk. So if there were a major correction in markets, and at this level of the bull market, that's not beyond the realms of possibility, we would be exposed at Macquarie Bank. So, but pairing it up against AMP, which is also market-facing, we've got two stocks. And interestingly, I don't need to go into the woes of AMP, but they're well documented. But despite AMP's very difficult 12 months and very uncertain earnings future, these stocks trade on roughly the same multiple, 13 to 14 times. And we don't think that in any way captures the risks in front of them. So in our minds, Macquarie would be able to outperform AMP in both a bull and a bear market, and in a perfect world, therefore, reduce or eliminate the financial market risks. And you can do the same in commodity markets where we have no confidence in, say, picking the gold price, but we might pair up two gold stocks as an example. And so it's just a little snapshot as to how you can hopefully eliminate a difficult to predict risk with bottom-up stock picking and pairs trading. In summary, we think segments of the market look expensive. We think you need to be a little bit careful about how you exploit this mature stage of the bull market, particularly with your defensive investments. The yield must be, as a minimum, sustainable. And finally, the shorting opportunities we see in this market are very plentiful. So I'll leave you with the performance of the long-short fund, and pleasingly, all the orange buckets are the three parts of the shorting market that I mentioned before, plus our longs, and very happy to say that all four of the buckets are positive. So thank you very much for your time.